Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, we are back here on the Investor Coaching Show. Paul Winkler, along with Jim Wood. So, just going through a list of the 15 worst performing mutual funds of 2023 and the lessons you can learn from this. You know, sometimes we have the lessons we learned from this, and I always have to point out, no, I learned the lesson, thankfully, 25 years ago. Didn't have to learn the lesson again this past year, but whatever happened, we see that all the time. And take note, people that put our podcast together, don't put it was as in lessons that we learned as in I learned, that maybe it's you learned. Or they learned, hopefully, or somebody learned, hopefully. But anyway, so it was the worst performing investments for 2023. And lots of Voya funds on this list. Oh, my goodness. The number 2 worst performing fund was, again, Jim, you'd find this interesting. Ultra short. Ultra again.
Yeah, there you go.
Pro funds ultra short NASDAQ in this particular case. They shorted the NASDAQ. And of course, NASDAQ is going to be very technology heavy. It's a platform where stocks are traded. And they were short in an area that you just didn't want to be short in 2023. It turned out to be a phenomenal area of the market. But there were people at the beginning of the year said this area of the market's just overpriced. It's overvalued. It's going to come down. It's, the stocks are selling for a high multiple compared to earnings. And I often point out when somebody says, you got to watch out when you got a high PE ratio. High PE ratio means a price is really high compared to earnings. That means that the market is overpriced. And the reality of it is, if it's a high PE ratio, it just means that the earnings yield is lower. It doesn't mean that it's going to come down. It just means the earnings yield is lower. And so it still has a positive expected return, but you can't predict this stuff. Any points on that?
Well, it just goes back to something I talked a little bit earlier about, in that it's if you and I are talking about this, or if somebody's looking online and sees this piece of information or anything, that's already known, and it's known by all the managers, all the hedge fund owners, all the pension managers, all the individuals looking at the computer, talking about stocks. That's available information. So it's subject to all the interpretation and the accumulated knowledge of that vast group. So to think you can look at that price and say that price is wrong and it's going to correct and I'm going to take advantage of it, then that's just not likely to happen.
Height of arrogance, too.
Yeah, you might get lucky, and
it's
sometimes
height of arrogance
that happens.
to think you got that down.
Yeah.
Well, the thing that happened is AI happened to it. I mean, you think about it, that was, people are, I think that they're starting to get the idea that AI is going to be a big deal going forward, artificial intelligence, and people were so scared of it. It was like, oh, this big boogeyman, it's, we're going to have robots taking over the world and, and Terminator's going to be popping out. And but the reality of it is, I don't know about you, Jim, but I'm going to tell you, I use AI type stuff all the time. I have an app on my phone, and I will use it because I'm looking for information. I'm looking for, my phone will grab information for me that I can use quickly and put a lot of different, and it'll lead me to studies even. If I'm looking for a study on a particular topic, hey, if there's any studies on this particular thing, and it may be whatever. And it's amazing how it'll say, oh yeah, there was a study on this done this year by this person. And then I can go out there and I can look in the research papers on things because I like to go dig deeper. Now, sometimes I found that it has led me to studies and it said, AI said that this is what the conclusion of the study was. And in reality, when I read the study myself, I came to a different conclusion. So you got to be careful about this type of stuff. But would I have found the study otherwise? No, I wouldn't have. So it is helpful.
Well, it's just I think at this point, no one really knows exactly where that's going to go and how it's going to be beneficial. But it's obviously one of those things that's here to stay. And it is truly amazing, some of the stuff where you give this thing a a couple of prompts, and all of a sudden it writes something that looks like a college thesis, that type of stuff. A little anecdote that's kind of funny. One of the times that I actually used it was I was having it I was just putting in some prompts and it would draw pictures. And so I was like, okay, give me 2 Airedales in the desert in the style of Salvador Dali.
What?
Airedale's a dog.
Okay, thank you.
It's a terrier. Those are my dogs.
Okay.
If you've seen pictures of my dogs, those are my dogs.
All right, that's what your dog is. Okay.
Yeah, and so I got a Dali-esque version of a couple Airedales. I got a version of Airedales in space, and that's just playing around. But just the fact that it can just go out there on its own.
You have too much time on your hands, man.
All this amazing information, and then how that will morph. Because what's really neat about this technology. There's a term for this, and I wish when I read it, I would have tattooed it somewhere so I remember.
Oh, no, don't tattoo it.
But it's like this new technology comes out and people get really excited and want to throw tons of money at it.
Yeah.
And in the early years, typically, though that money does, it doesn't get market returns or whatever.
Right.
But then, 10 years later, it's exploded in ways we never could have comprehended. And that's happened, that happened with the internet. That's happened with other things. And so it'll be interesting to me to see, where does this go and explode and change things that people aren't really even thinking about at this point.
Well, I think you're going to be excited to know that the AI convention happened this week. And one of the things they've got out there now is a car that senses how you feel. What it does, I have no clue, but it senses. Seriously, I am not joking. I am not joking.
An automobile.
An automobile. You get in and it senses how you feel when you're in a traffic jam.
Oh, this guy's depressed. It pulls into a bar.
I don't know. That may be it. I didn't think of that one, but that's really funny. So the last one was the Ridex. Yeah, you love the Ridex Inverse NASDAQ 100 2X strategy.
Yeah, see, that's what I was referring to earlier. That's the stuff you expect to see on a list like this, because it's easy to blow yourself up using that type of stuff.
Well, it's amazing to me that there weren't more like that.
Yeah, no, that's what I mean. When you kept talking about funds that were more mainstream, I was like, really?
Yeah, like a sustainability fund, and then you've got the emerging markets equity fund and an all China equity fund, the Voya Mid Cap Opportunities Fund, Voya Global Bond, and Voya Large Cap Growth. They're probably hating all this press, but the squirrels are really mad. I'm just saying. But you have a lot of funds that you wouldn't have necessarily thought. And I'm glad, in a way, that there were so many funds that you wouldn't normally have thought, so that people can wake up and recognize that these big mutual fund companies and big investment firms are doing things that you just really don't even know that they're doing. You think it's just a big weird name fund and that ended up with this bad performance, but it's a lot of other funds that you think, well, that seems like fairly normal stuff. And that is what people ended up getting torn apart. Now, I'll save this till after the break. But I got to tell the story about the Mainstream Investment Company.
Yeah, we was waiting for that. You teased that last segment, so.
Yeah, I'll do that after. I'll do that after. Thanks for tuning in to the Investor Coaching Podcast. Now, you may be one of these people that's been listening and realizing, wow, investing, there's a lot more to it than meets the eye, and financial planning, tax laws constantly changing, and recognizing that maybe you might need some help in this area, but you don't want just anybody to help you out. So we have 10 offices in the Middle Tennessee area, and everything that we do is fee only. We align our interests with your interests. So you can get an initial 15-minute phone call with any one of our offices just by going to paulwinkler.com/call. That's it. Every one of the offices is run by somebody with 20 plus years experience. They're all degreed planners. They all have academic backgrounds in investing, and you can get the help that you need. So if you want to set up a complimentary phone consultation, just go to paulwinkler.com/call. And we look forward to seeing you soon. So we've been talking about the 15 worst performing mutual funds in 2023. And I got an invitation on a social media platform that my background was perfect for a job to be a portfolio manager for a major investment firm that has offices, I don't know, hundreds and hundreds of offices all across America. Thousands maybe even. But anyway, I told my wife, I said, well, this would be such a fun job. Just going in there and straightening up the portfolios of this huge investment firm. And, she was like, yeah, right. And I said, yeah, the thing is that the changing the culture at an investment firm, just darn near next to impossible. I mean, we've known guys that have tried to do it. I remember, a friend of ours actually going to a broker-dealer conference and actually talking about some of the stuff that we talk about here on this show, Jim. Yeah. And what happened to him?
He was not received well.
You have a gift for understatement, my friend. You have a gift for understatement. Yeah, I mean, literally, just about railroaded out of town.
Yeah, tar and feather.
yeah, pretty much. But I had this instance that I was actually a big salesperson, which was kind of weird for me. But I actually believed in this one product that was put out there. And I wanted to expand some of the offerings in the product that were non-stock picking, non-market timing related. Because I was getting into all this academic investing and three-factor model and multi-factor and market efficiency and how to determine what factors were actually being applied in a portfolio design. I get really nerdy in this stuff because I really, really enjoy it. So I was actually brought up to Chicago, of all places, Jim, and I actually was brought in on a limousine.
Ooh.
Yeah, I mean, this is like big stuff, man. So brought in a limousine, and we were in a boardroom, a fairly small boardroom. And we were talking about things that we could do to make this product better. What could we do to really get it out there? And I said, we need to expand the offerings in the fund that are managed in this particular manner. And the lead portfolio manager for the fund company looks at me, this lady that was the lead portfolio manager looks at me and she goes, "Oh, Paul, that's not sexy." I was shut down. I was shut down in a heartbeat because what I was talking about wasn't sexy or wasn't what I was like, what does this have to do with that? We are trying to put together a product that's really good for clients that may make sense for them for their retirement portfolios. And that's what that was it. They did not do anything that I recommended. And I left and I was gone. I was like, and that was the last I ever worked with the company.
Yeah, that sounds, very familiar in the way that when I started studying the academic side of investing and wanting to provide that to my clients when I was still at the broker-dealer, I went there and said, "Hey, I want to do this, this, and this, and this." They wouldn't approve any of the marketing materials. They said, "Oh, we can't do this." And it was because I was going out and telling people that what all the other reps were doing was the wrong way to do
criminal.
stuff. Was
Not quite
bad.
criminal, but
yeah, it was likely to result in poor performance next to this. And so they couldn't have those two competing messages.
Right.
And they had, 99% of the company doing it the old way, gambling and speculating, that type of stuff. And then coming in and saying, "No, that stuff doesn't work. This is what you should do." Yeah. They didn't want to approve that.
Yeah, you're not going to get any traction.
It wasn't sexy.
No, it wasn't. Well, let's just face it, neither one of us are.
No, speak for yourself there.
Paul. I knew what you were going to say.
Yeah.
I heard that coming from a mile away. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.